Hello students, welcome to my channel. I hope your preparations are going very well and you are wrapping up your revision and all. And I made a last video on relating to this PGBP chapter as well as company assessment, the top 40 adjustments. Okay, if you haven't watched that video, please go and watch. It is available there. And in that material in the comment section, and one of the students has asked for a revision lecture. So I may not able to make a complete revision of the 40 adjustments, but I will try to make top 10 adjustments because in the considering the time availability of time for you, I'm making a video on the top 10 adjustments. These top 10 adjustments are very interesting and very important for this exam also. So you can watch it now or you can pause it here and you can watch it on the day before the exam in the fast forward mode. You can just watch it. I will try to complete as early as possible. This is a super fast quick revision video for these 10 adjustments. Okay, the first adjustment that I'm going to take is section 37 adjustment, which is an amendment. It is based on the Supreme Court judgment. There is a consequential amendment in the section 37. Okay, I'm directly going to that adjustment. Yeah. So I'll explain the case study in just in a minute. So there is a pharmaceutical company. There is a pharmaceutical company. Pharmaceutical company name is Apex Laboratories, and there are doctors in the same city. This pharmaceutical company is manufacturing some drugs. For example, take XMG drug they manufacture, and to promote this, what they are doing is this pharmaceutical company is going to give these medicines to the medical practitioners and tell to the medical practitioners suggest this medicine to the patients. So, they are suggesting this medicines to the patient, and in return to that, in return to this service, doctors are getting some freebies. Like freebies can be anything. It need not be in a cash. Freebies can be like a holiday trip, or any concessions, or any school fees concessions for the kids. Anything can be done. So at the end of the year, these Apex Laboratories, while they're preparing their P&L, they have charged this entire expenditure to and debited to the P&L in the name of promotional expenses. Whatever expenses that are incurred for in form of freebies to the medical practitioners in the city. So the entire amount was shown as a promotion expenses. It went to the assessing officer. Assessing officer disallowed that expenditure, saying that it cannot be allowed as per section 37 subsection 1. Now the question is whether it is allowed, whether it is disallowed. The case went to Supreme Court, and Supreme Court said, given in favor of the department, this expenditure cannot be allowed under section 37 subsection 1. The reason is, so there are some regulations, this Indian Medical Council, if you can see Medical Council regulations, Indian Medical Council regulations, there is a bar on giving the freebies, bar on accepting the freebies by the medical practitioners from any pharmaceutical company to promote their drugs. That is one of the regulations that was existent. In section 37(1), it says this section doesn't allow any expenditure which is prohibited by law, right? So by combined reading of the both these provisions, this expenditure which is incurred in the name of promotion should be disallowed. Okay, that is the consequential amendment made by the department in under section 37 subsection 1. You can see here, expenditure incurred in form of freebies is not an allowed expenditure in the hands of the pharmaceutical company, and the case law also you need to quote. This is very important, and you can expect a adjustment in the company assessment. Okay, I'm moving on to the next one. This is also based on the amendment only. This is related to section 35. So section 35, that any research institution, university, college, okay, if you give any donation, 100% of the donation what you have given will be allowed as a deduction. But there is an amendment here. The deduction is not available if there are two conditions. They said, if the particular research association, university, college has not furnished a statement to income tax authority in prescribed time, and they said, and here these two conditions should be satisfied. Furnishes a certificate to the donor containing the amount of data contribution and other details. They have to give a certificate to the donor, and at the same time they have to give some particulars in the prescribed time, the prescribed form, to the income tax authority. If they have not followed, these both things are not followed, the expenditure what you have given, you don't get any deduction. If you take a deduction, that will be added back by the assessing officer. Okay, by virtue of this amendment. This is the second adjustment. Moving on to the next adjustment, which is the adjustment number 24 in the material. The material link I have provided in this video also, into my earlier video also, and you can download from anywhere. And adjustment number 24. Payment of 0.25 lakhs and 0.3 lakhs in cash on 3rd December 2022 and 10th December 2022 for purchase of a raw corn to an agriculturalist and 0.3 lakhs to a spice trader. So typically 0.25 lakhs they pay to a raw corn agriculturalist and 0.3 lakhs they pay to a spice trader. Immediately when we see this, the most of the students will take the that it was section 40A3, which is a cash payment in excess of rupees 10,000, other than by account pay check or account pay bank draft or through an ECS system. If it is not through these modes, then that the same should be disallowed 100%. This is the provision, right? Immediately they will add 0.25 and 0.3 lakh, total 0.55 lakh, that is 55k. They will disallow in the computation, but that is incorrect. The reason is payment of 25 lakhs and 0.3 lakhs in cash on 3rd December and 10th December for purchase of raw corn to an agriculturalist. Here the point to be noted is agriculturalist. There is a rule called Rule 6DT, which is an exception to 40A3. Okay, one of the exception is related to the payment to an agriculturalist. If the payment to an agriculturalist, this 10,000 wala rule is 10,000, otherwise than when account pay check, account pay backdraft or ECS system, this particular rule is not applicable. So the payment of around 0.25 lakh, that is 25,000, which is paid to the raw corn agriculturalist is exempted. And now it comes to the 0.3 lakh, that is 30,000 rupees paid to a spice trader. Here the word they mentioned trader, not agriculturalist. He is a middleman. Okay, he's a normal trader. So the payment of 30,000 made to the spice trader should be disallowed as per the 40A3. So 25,000 is exempted and 30,000 is disallowed. Okay, that is 40A3, and there will be a chances that there will be a confusion and you may disallow the entire amount. That's the reason why I took this adjustment. Now I'm moving on to the next adjustment, which is an interesting one again. Section 43B, adjustment number 27. And in this case, a company took a bank loan of around 350 lakhs and the interest rate is 8%. And they took a loan on 1st May 2020. For what purpose? They want to purchase a machinery, which is a fixed assets. Now, as on 31st March 2021, there is a interest liability was there. They have not made the payment on time and they have made the payment on 1st 11 2021 and machinery put to use on 1st February 2021. Now, what is the respective provision is applicable? That is section 43B is applicable. So interest on bank loan which was not paid on time, it will be allowed as an expenditure on actual payment basis if it is paid on or before the return filing date. Okay, that is what the section 43B is about. So in this particular case, if you see, and usually when you read this particular adjustments, 350 into 8%, whatever amount will interest amount will come, we will try to disallow because the interest amount was paid on 1st November 2021 because the return filing due date is 31st October 2021, right? It is paid just after the return filing date, so it should be disallowed. But in this particular case, there is an involvement of fixed assets. They took the loan for the fixed assets and the asset is put to use on 1st September 2021. This is the important point to note, because the interest expenditure in this particular case has to be divided into two parts. The interest liability from the date when we took the bank loan till the date the asset was put to use, from the date asset put to use till the balance sheet date. There are two parts you need to divide the entire interest. The entire interest on this for the whole year is 25.67 lakhs on 3,50,000 into 8%. Now this 25.67 lakhs divided into two parts. One is the period which is relating to period which is related to the date of the loan, that is 1st May 2020 and till asset was put to use, that is 1st February 2021. For this entire how much it is 8%, 9 months, it will be 9 months. For this 9 months it should not be debited, should be debited to the P&L. It should not be even debited to the P&L. It should be added to the cost of the asset. This expenditure which is incurred from the date of the loan till the time the asset was capitalized, that particular interest portion has to be added back to the cost of the asset. So from 1st May 2020, that is the date of the loan, and 1st February 2021, which is the asset was put to use, the interest liability has to be capitalized and added back to the cost of the asset. This is the important point to note. And from 1st February 2021, that is after the asset put to use till 31st March 2021, which is a 2 months interest has to be expensed, but this expense should be disallowed because it is paid on after the return filing date, that is on the 1st November 2021. Okay, this is what the adjustment is all about. But normally students tend to disallow the entire expenditure of interest portion 25.67. They ignore the fixed assets impact here. That's the reason why I took this adjustment. I hope you are clear. I'm going little fast, I know, but yeah, considering the time availability, I'm trying to help you to further revision. I'm going little fast. Adjustment number 30. Adjustment number 30 in the material. This is an amendment. An unpaid interest is converted into a debenture or any other instrument. Will this be considered as an actual payment? The answer is no. This cannot be considered as an actual payment as per section 43B because there is no actual payment is involved here. Whatever unpaid interest liability is there between the agreement between the company and the bank, they are converting the unpaid interest portion into a debenture. This is just a reschedulement of the loan. There is no actual payment involved. 43B expenditure will be allowed on only on actual payment basis. This cannot be a case of the actual payment as per 43B. This cannot be an allowed expenditure. That is the amendment, a small amendment. Now we will see two small adjustments. That is adjustment number 15 and adjustment number 18 in the material. Adjustment number 15. And a company incurred a share issue expenses worth of 5 lakhs. However, public issue was rejected by SEBI. So they incurred some expenditure, issue expenses, but finally SEBI has rejected the issue and it was stopped. Now this is a revenue expenditure or a capital expenditure. So the clarification is this is still a capital expenditure because the nature has not changed. The issue expenses still needs to be considered as a capital expenditure. If it is debited to the P&L account, it should be added back. Okay, that is the adjustment. Share expenses should be disallowed. Next, adjustment number 18. Adjustment number 18. This is the interesting one. Like a company, some says one of the cashier from the company went to an ATM and withdraw the cash. And when he comes back out of the ATM, somebody came and ran away with the bag. The bag contains around 25 lakhs. Now, what company did is company said that this is an unrecoverable loss to the company. They have actually charged this entire 25 lakhs as a revenue expenditure to the P&L and as an unrecoverable loss. Whether this theft, whatever the unrecoverable loss due to theft is allowable expenditure or not, the answer is yes, interestingly. Because this is an unrecoverable loss, this is a very unfortunate incident, this is a very exceptional incident. So this was actually and considered as an expenses and allowed as a deduction. And if you see here, blue, theft which is an unfortunate incident, same is considered as normal and unrecoverable business, and the same is allowed as a deduction. And this is considered as a normal business expenditure. As an exception to it, under section 37, the same is allowed. Okay, this is adjustment number 15 and adjustment number 18. Now we'll move on to the another one. Just a minute. Yeah, this is a general, comes under the general category. And if you see the adjustment is adjustment number 33, opening and closing stock for the year were 55 lakhs and 54 lakhs respectively. Opening stock was overvalued by 10% and closing stock was undervalued by 10%. So now opening stock is overvalued. Opening stock is overvalued means profit will decrease or profit will increase. Opening stock overvalued means we are claiming more expenditure, more expenses in form of stock. That means my profit will decrease. Okay, if it is overvalued, then what we need to do? We need to deduct. We need to deduct from the adjustment. We need to deduct from the profit. Sorry, we need to deduct the same from the profit. Whatever 10% overvaluation is there. So the opening stock is 55 lakhs. So 55 lakhs is the 110 value because it is overvalued by 10%. Now what is the 100 value? So 100 by 110 by 100 into 55 if you do, then you will get a that 10% related portion that you should add it back to the profit. Okay. Similarly, closing stock was undervalued by 10%. So closing stock undervalued. That means it is actually in form of credit. It is a credit to the P&L, right? So closing stock was undervalued by 10% means we have shown the profit undervalued. Profit was undervalued here. Then again, this has to be added back to the profit. P&L. So both the sides, opening stock and closing stock, in this particular adjustment, you need to add it back to the profit. Okay. Now I will tell you simply. For example, opening stock overvalued means what? It should be adding to the profit in the adjustment or not? Yes, this has to be added because we have overshown the expenditure. So this should be added. opening stock undervalued. Undervalued means we have underclaimed the expenditure in form of opening stock. So profit was overvalued. Then what needs to be adjusted? Here the respective undervalued stock needs to be deducted from the profit. Similarly, closing stock overvalued. Closing stock overvalued means we have actually shown the excess profit, because closing stock overvaluation is credited to the P&L. That means we have shown the over profit. Then as an adjustment we should deduct it from the profit. Similarly, closing stock undervalued. Closing stock undervalued means we have shown the profit lesser, so this needs to be added back. Okay, this is the adjustment. Many students get confused here by adding, or I need to add or I need to deduct and all. That's the reason why I took this adjustment. Now we will move on. 33, I think next 34 only. Yeah, 34. There is a adjustment related to hedging contract. I have seen this adjustment in 2-3 previous attempts, so that's why I took this adjustment here. So what was happened is there is a profit. Company got some profit by through hedging contract. This contract they made to cover their foreign exchange relating to a fixed assets. So whether this profit is chargeable to tax under section 28, that is a as a business income or not, that is the question. So this income includes, this income needs to be deducted from the profit, and the same is adjusted to the block of the asset. Because this hedging contract is particularly related to the fixed assets. If it is related to the fixed asset, the respective profit has to be adjusted to the asset. Adjusted to the asset means we need to deduct it from the cost of the asset, this hedging profit, because it is related to the fixed assets. So this is not an allowable expenditure to the P&L. Till here, students will do the adjustment. But what about the depreciation? You have to add back the depreciation also. That is the critical adjustment here. So for example, if the asset is purchased during the year only, then you need to consider the actual depreciation as well as additional depreciation, excess additional depreciation, if any, in the adjustment portion. That is the critical adjustment here. And depreciation should be deducted from the profit. If the asset is a plant and machinery, check for the additional depreciation provision as well. That is the criticality of this adjustment, hedging contract. Now I will move on to the last adjustment, that is important adjustment, that is taxation of VDA, which is not covered in this material because it's related to capital gains. I hope you have already gone through this amendment, so I'm not going much into the details. I will directly go to the adjustment. So taxation of VDA, virtual digital asset, is nothing but a taxation of cryptocurrency. Cryptocurrency, example of cryptocurrency is best example is Bitcoin. So for example, there is a company called A Limited, and it holds bitcoins worth of around 20 lakhs, INR 20 lakhs. So it sold to B, an individual, for example, 20 lakhs. 20 lakhs for 20 lakhs they sold these bitcoins to Mr. B. Now, in there, how the capital gains in adjustment will happen. For example, if A Limited has incurred some expenses also on transfer of this, some legal expenses and all, transfer of these documents and all. For example, let us take that is 1 lakh. And when A Limited purchased this Bitcoin, the cost of the Bitcoin is, for example, let us take 10 lakhs. My writing is not that well. Please adjust with that. So the company called A Limited, it has Bitcoins. It sold it to Mr. B for 20 lakhs. Expenditure on transfer of Bitcoin is 1 lakh. And cost of the Bitcoins, when they purchased it, it is 10 lakhs. Now, the question says, compute the capital gains. So section 115 BBH is the chargeable section for the transfer of VDA asset. Okay, tax rate is 30%. 30% tax rate is applicable in this particular case. For example, here, okay, let me take another Word document. Yeah, so the cost is how much? 10 lakhs. Sale value how much? 20 lakhs. Now the net capital gain how much? Is 10 lakhs. Now the question is, whether this expenditure incurred to transfer these bitcoins, that is 1 lakh, whether this is allowed or not. This is not allowed. This is the issue here. So expenditure on transfer, usually in the capital gains problems, expenditure on the sale consideration to the extent of 1% of the sale consideration will be allowed as a expenditure, right? That is allowed as a deduction. But in this particular case, this expenditure on transfer of the asset is not allowed. And further, in the question paper, they will give you even the index numbers also. They will give you cost of the asset index number is this, and the 2022-23 previous year index number is this. So please calculate the capital gains. So indexation benefit is not applicable for transfer of cryptocurrency. That is point to be noted. And further, the loss against the cryptocurrency cannot be adjusted against the profit against the cryptocurrency. So previous year they have a loss around 10 lakhs. This year they have a capital gain of 10 lakhs. Whether this profit can be adjusted against the loss of the earlier years, the answer is no. Again, for example, they have a business loss of last year, let us say 5 lakhs. That 5 lakhs business loss or house property loss can be adjusted against this 10 lakhs of profit here. Again, the answer is no. No loss, even it is related to the cryptocurrency of previous year's loss also, cannot be adjusted against the profit from the transfer of the cryptocurrency. That's the important point to be noted. This is the adjustment related to this, and there is a TDS implication also. So this is the adjustment when the company is selling to the outside. What if company is buying it? For example, here the A Limited you take. A Limited, instead of selling the Bitcoin, they are buying the Bitcoin from Mr. B. For example, Mr. B. Mr. B is the seller. So while transferring the consideration by A Limited to B Limited, they have to deduct 1% TDS under section 194S. If the company buys it, the TDS implication will be there. If companies sell it, then the capital gains tax will be there. Okay. Let's quickly revise this 194S and taxation of cryptocurrency. Taxation of cryptocurrency under section 115 BBH. Okay, there is a tax at the rate of 30% is applicable on transfer of the cryptocurrency like Bitcoin, etc., etc. So this only one cost that is allowed from the sale consideration, that is the cost of acquisition. There is no other expenditure like indexation benefit is not available, and sale expenses were not allowed as a deduction. Okay. And then, so if company is selling it, then capital gains implication will be there. If company is buying it, there will be a TDS implication will be there. Company has to deduct the TDS under section 194S at the rate of 1% of the consideration before making the remittance. Okay, this is all about adjustment number 41, that is related to taxation of PDA. With that, we have completed all top 10 adjustments, and that's all I have for this video. And I hope you enjoyed this video. And last thing, all the very best for your examination, all the very best for your examination. And further, this material is available in the description box. You can download and you can utilize this material on the day before the exam, and then tomorrow and day after, before you stepping onto the FR study, and you can revise this material once. Okay, all the very best for your examination. Give your best, no matter how your preparations went in the past. From now onwards, give your 100% focus, 100% of the examination. You will definitely able to crack it. Okay, all the very best. Signing off, this is Viresh. Bye.